Automotive stocks are at 5-year lows, which means now is the time to buy, no? Of course, I always follow your comments, which also helps me following sectors, and in this video I want to discuss Stellantis, that's down 66% from the recent 2024 peak, huge cash position, we'll discuss that. Ford, also down, not as much as Stellantis, but Volkswagen is down also 30% over the last 5 years, 60% from the 2021 peak. Looking at stock prices, the declines, from a stock price perspective, it is the best time to buy over the last 5 years. That's simple maths. Let's start discussing the sector by analyzing Volkswagen for starters. The stock price is, let's say, in a downward trend clearly and in a very cheap range. Market cap, imagine you can buy the largest automotive producer for just 50 billion. An online company that makes no money is worth 10 times more than that. That's the world we are living in. But what does that mean and why is that so? Let's see. If we look at the start of 2025, sales plus 1%. However, the operating result is down 37%, and that is even on the lower 2024 situation. They are still selling cars. They have this decline in China, but the profitability is going down. They have now this China for China production, so same as is going on in America, we have to also do it in China, because also China wants to do things themselves, even more that they are already doing. However, we have new models, constant investment, new development, high competition, and that leads to lower prices. Okay, they have also lowered the costs. However, they also expect battery cost reduction by 2026. And that is then in connection with the lithium sector that we have analyzed. Of course, the link of the video will be in the description below, because lower prices of batteries mean also lower lithium prices, which that translates again into lithium stock prices. These are very connected sectors. Vehicle sales, okay, stable sales revenue, even up a little bit. However, operating results down, and operating margins 3.7%, down from the 6% the same period of 2024. I want to focus on these margins because look at the margins here, already declining, but 7%, 5.4%, and the company has been targeting 10% operating margins in the good times, 2022, and I always said that yes, 10% is the peak in good times, but this is a cyclical industry, and this is now the downward part of the cycle. And you can see here the projections 2020, 2021, operating margins in the range of 7% to 8%, and also longer term targets, operating returns on sales 2025, 2026, 8 to 9%. We are now at 3 at best. So this is huge changes, but this is the cycle. And whenever you look at this 2021 presentation, you will see these strategic outlooks that are always too exuberant, not taking into account the real cycle there. So the return on sales, this is the strategic target. Look at this, 8%. High margins, everything looked great back then. The stock price was 3 times higher almost. But when we look at the operating margins, we have to understand the cycle. Bad times, good times, bad times, okay times, bad times, okay, good, good, good. Okay, 1 year, but we have had huge years of great margins. And now this might be the case, and this is the cyclicality that nobody talks about when it comes to these companies. We'll see how 2025 ends up, but they are always discussing adjustments and things like that, restructuring, provisions, firing people, things like that. That is something that will always be there, especially in bad times and especially in Germany. However, China also, current issues, competitions. Again, these projections that somehow this will get better. Perhaps it will, perhaps it won't. However, if we look at sales, those are there, but these small changes in margins have a big impact on profitability and everything. If we look at things now, the outlook from 2 billion to 5 billion for the automotive reported net cash flow. 2 to 5, maybe it will be 3, and then if you compare it 3 to 50 billion, that's not staggering. That's just, let's say, fairly priced stock with a P ratio of 15. No miracles there. Of course, we can look a little bit at the balance sheet and then we can see the total equity is 200 billion. Then you're paying 50 billion for 200. That's price to book value of 0.25, a quarter of book value. But then there is a lot of debt, mostly for the financing thing. However, you also have to understand that this debt, European debt, is 1% interest cost, which is practically free money. And this is where Trump is completely right about discussing the competitive advantages European producers have compared to Tesla that is paying 4 or 5%. Now, on that value, 200 billion, you pay 50 billion. It's not that they can sell their factories in Germany for that money. Maybe they can sell some brands like the Lambo and things like that, get some cash flows if needed. But again, you never know who is going to pay 10, 20 billion for that. And there is always the question of the unlocking of the value. The value might be there, but you unlock the value through cash flows. And cash flow is king always. And if I look at Volkswagen, look at this, issuance of common stock, constantly has been issuing stocks for their acquisitions or whatever, repurchasing just a little bit in good times. If I add dividends paid compared to issuance of common stock, Volkswagen hasn't made any value for shareholders till 2022, and only in this period of boom they have made 20 billion of value. Now, if I compare the 20 billion compared to the market cap here of 50, you say in 3 years, if that happens over 6 years, that's great, I get my money back. However, that were exuberant years, everybody was getting money from the pandemic relief programs. They paused buying a new car in 2020, and then was huge demand, prices were high, and these companies were flushed with money. Now, competition is sky high everywhere. The Chinese companies are entering. They need to invest a lot in new cars, new technologies, and we haven't yet seen a recession or significantly higher interest rates, at least in Europe. If we look at the balance sheet, you see here the values. There is this long-term debt that is mostly from the finance division. Okay, there are again loans and leases as assets there, but there is also 100 billion of intangibles. So there goes your 0.25 to 0.5 tangible book value. However, interest expense on 150 billion of that is just 3.5, plus they have the interest income on their loans. So I would say now that we are at a 2 to 5 billion free cash flow, which is likely the normal going forward for Volkswagen. Recession, higher interest rates, global economic slowdown, we are going into negative territory. So we are now at the mid part of the cycle. When will the next boom come? Hard to predict. Will there be a downturn? Again, impossible to predict. My crystal ball broke, so I can't predict that. However, I think that now we are at mid-cycle. One day they will get again to 6, 7, 8 billion of free cash flow. Stock will likely 50% to double. If there is a recession, you can still expect 50% down. And that is where we are now with Volkswagen. Let's go to Ford. The stock is more stable over the last few years, and Ford has taken the America's first auto manufacturer. Okay, good, but still a global brand. And you can see here how revenue is down 5%, EBIT 63%, EBIT margin down to 2.5, free cash flows going into negative 1.5 billion. And that is what happens when the cycle turns. They have these US retail loss to receivables. That's also a credit risk with these companies. Nobody thinks about credit risks because ECB and the Fed have been bailing out everyone. But you see here that it is a risk, especially if auction values fall in a recession, this goes up, so there can be also credit losses. Anyway, they have cut their guidance because of tariff, or I simply think they have cut it because things are not going as they're projected. Very nice. I'm very interested in this trailer, for example, for my boat, but that's a different story. Guidance there was for 2025. Everything was discussing growth or stability, and then as that doesn't happen, they have suspended the guidance. I don't think the tariff or near-term risks are the key. It's just the cycle in the automotive industry with high competition that then leads to lower pricing, lower margins, lower everything. And if I look at US total vehicle sales, we are here. We are still in good times. We are not here. Look at this recession, this recession, this recession. If we have now a recession in the US, commercial vehicles, Ford gets hit, then we are still in the mid to good part of the cycle for Ford. If you look at net income, revenues go up and down. You see these declines, okay, 2021, but this is a real decline. You see then big losses. Let me put this 15 billion of losses, 12 billion, 15 billion, and here a little bit of stagnation. On average, Ford makes 3 billion of profits. And you can see here that it is trading at equity, so there is no miracle valuation there. Price to book trading, and 3 billion, that's a 7% return. That's enough for the dividend. And if they can keep the dividend investors will be happy. But if there is a real decline, like it happens here and there, then we have not yet seen the ugly part of the cycle. The next one to discuss is Stellantis, 66% down, more cash than the market cap, and that is what value investors are looking at. So they see more cash, they think it is value, but let's discuss that part of this car segment. So declines 9%, 14%, they are still launching, investing, even Grande Panda, even if that sounds like an oxymoron. Nevertheless, tariffs, issues, net revenues down 14%, of course, suspending financial guidance like everyone else. But if we look at the industrial cash flows, minus 6 billion. So this is it, from plus 8-9 billion a few years ago, they suddenly go to negative free cash flows, and that is how the money deteriorates and goes away. Adjusted operating income went from 24 billion to 8 billion with the capex, interest and all, negative free cash flows. And if that continues, then the situation might get even uglier. Yes, they are trying to do everything. They will still pay the dividend. However, we will see what will the situation look like in 2025. They have cut the guidance because this is wrong, this is wrong, this is wrong. So we'll see for how long will this situation last within Ford, Fiat, Stellantis and things like that. However, the debt there is not that much. They have huge cash and cash equivalents, even if you see that declining 44 billion, 36, 34, likely will be at 28 by the end of this year. And then you say still more cash than the market cap. However, if again we look, these were great times with 7-8 billion return to shareholders per year through repurchases and dividends, and then you say 7-8 billion, just 3 years of that covers for the market cap. However, if we look at the equity price to book value 0.5, and then we look at this. This is the cash and cash equivalents after the merger of 2021. This is after the merger, the cash jumped. However, liabilities jumped even more. Cash went up from 24 to 48, so 2x. Liabilities went up a little bit more, from 50 to 150 billion. And we are now at what, 30, will be 38 billion of cash flows. And if I just put 2 billion for each of these bigger companies that they need to have, and that's already 20 billion for their investments and everything. So there is not really a lot of cash there. To conclude on the automotive industry, yes, we are at 5-year lows. However, it's not really the ugly. We are still at good sales, just high competition, even if everyone is bleeding. So if you want to play the cycle, you can start investing a little bit again. As I said with iron ore, we are still at mid parts, and that is the key. 2x is possible, but also minus 50. And we must not forget that car companies do go bankrupt in big crisis. That is the risk and reward. I hope I have helped you a little bit with my opinion. Thanks for watching. Check my quadrant analysis for better risk and reward, or at least less risk ideas.